This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Herb Greenberg, who reminds investors that risk is real. With Herb Greenberg's Reality Check, researching stocks in terms of risk. You can learn more at TheStreet.com/realitycheck.
New heights. Investors are back from the beach and in an optimistic mood, sending the S&P 500 to a record close. The head of Charles Schwab, one of the nation's largest investment advisors, tells us what his clients are doing with their money.
Stay tuned. Pfizer may have abandoned its bid for AstraZeneca and ditched plans to create the world's largest drug company. But the story is far from over.
And power surge, why utility stocks are this year's darlings, and can they continue to outperform? We have all that and more tonight on Nightly Business Report for Tuesday, May 27th.
Good evening and welcome, everybody. Back to work and back to setting records. Investors return from the long holiday weekend in a buying mood, pushing the S&P 500 into record closing territory and driving the enthusiasm today with deals and data. Pilgrims Pride offering to buy Hilscher brands for more than $6 billion. More on that one in a moment. And on the economic front, orders for durable goods rose unexpectedly. Confidence climbed, and according to the Case-Shiller Index, home prices are still increasing, though not by as much as they had been. By the close, the Dow gained 69 points to finish at 16,675. The Nasdaq added 51, the S&P 500 up 11 to close at that all-time high. And there were other milestones in today's market. The transportation and materials sectors sitting now at all-time highs, while technology stocks are at levels not seen since the year 2000. But this year, believe it or not, the biggest winners as a group are utilities. Yes, utilities. They are the top sector of 2014 so far, up more than 10%. Dominic Chu takes a look at why there's so much interest in this staid and stable industry and why boring may be beautiful for you.
They may not be all that glamorous, but utility stocks have been Wall Street darlings so far this year. And there's a big reason why. Dividends.
The utilities tend to have a higher yield than, say, some of the S&P 500 companies. Utilities tend to grow their dividends pretty consistently every year.
Utility companies tend to pay out more of their profits to shareholders rather than reinvest all those profits back into their business. So, if you're an investor looking for an income stream from your investments, utility stocks can play an important role. Jill Cuniff is president of Edge Asset Management, and her firm manages over $26 billion in client assets. They've got a specific focus on income generation, and they invest in, among other things, utility stocks. Among her favorite picks in the sector are companies like Sempra Energy, which owns utilities in Southern California as well as Latin America. She also likes Wisconsin Energy in the Midwest. Both companies have a dividend yield of around 3% and have grown their dividends substantially over the course of the last 5 years. Another big reason that investors like utility stocks is their relative immunity to the ups and downs of the overall economy. No matter what, customers will always spend money on electricity and natural gas. They literally power the American economy, no matter how strong it is. But, as with all investments, there are risks. Utilities are no exception, especially if bond prices start to fall and interest rates begin to rise.
When yields do rise back, the first thing investors will do is sell utilities. Utilities are being bought for non-fundamental reasons, which is basically their dividends. But if you look at the S&P in the total growth, most of the utilities have very low to no growth.
So, the bullish case for utilities involves generating investment income from dividends. The bearish case for utilities involves an improving economy and rising interest rates, which could put a damper on low-growth safety stocks. No matter what your view, utility stocks are definitely worth paying attention to. For Nightly Business Report, I'm Dominic Chu.
So let's find out what our guest is paying attention to. He's Walter Bettinger, Chief Executive of Charles Schwab Corporation. Walt, so nice to have you back on Nightly Business Report. Thanks for joining us.
Well, thanks for the invitation, Susie. It's great to be here.
Let me begin by just getting your gauge on investor sentiment, because today it was really nice. We had all these records on the S&P, but a week or 2 weeks ago, we had big sell-offs. What is investor sentiment like from your perspective of the Schwab clients, and where are they putting their money these days?
Well, I think the sentiment of our investors continues to be taking a long-term view and investing their portfolio based on their goals and objectives. As you indicated, Susie, just a couple of weeks ago, the headlines and many of the articles were investors selling their equity portfolios, the old sell in May and walk away for the summer type headlines. We know that timing the market is almost impossible. You got to get it right twice. You got to know when to sell and when to buy. It's just too hard for most people to do. Our clients are taking a long-term view. They've been net buyers of equities for well over a year, and we expect that to continue in the future.
It's been, Walt, a little bit of a surprising year. Bonds have basically outperformed most categories of stocks, at least so far this year, notwithstanding the recent gains. What do you say to investors when the markets confound the predictions with which we began the year?
Tyler, I think we say that's the markets. Nobody really has that crystal ball. And as I always say, the more certain a person sounds that they know what the future holds, the faster we should all run away from them. The bond market has its own life. It's clearly getting some impact by Fed decisions. And as they've made the moves, continuing to keep downward pressure on rates, for the most part, the bond market has responded this year.
Mm-hmm. You know, Walt, I was interested that just a few days ago, your colleague, Charles Schwab himself, was saying that he thought that index funds is the best way for 98% of American investors. You obviously agree with it. Tell us why, and why now? Why index funds now?
Well, as I indicated earlier with respect to market timing, it's so hard to get it right. You have to be right twice, when to get out, when to get in. And the point that Chuck was making is that for most investors, simply being in the market is a winning strategy. We've all seen studies where the market has gone up, say, 8% on average, but the typical investor's only captured about half that because they make those moves in and out. And Chuck's point was, buy the market, stay in the market, and you're likely to capture the upside gains over an extended period of time. That's the beauty of index funds, and Chuck and I have both been longtime supporters of them.
Of course, they're both very tax efficient and also inexpensive to own. Let me turn you to an industry issue. I was at the Investment Company Institute's meeting last week, and one of the concerns there is the possibility that large asset managers, and I would include Schwab in that category, might find themselves declared by financial regulators as financially significant institutions. How do you feel about that, knowing that an awful lot of your colleagues in the fund business oppose that vigorously?
Well, Tyler, I have to say, in fairness, before answering the question, that at Charles Schwab, we're already under the Federal Reserve's oversight. So we're already in a category in which the Federal Reserve plays a meaningful role in regulating our firm. I think the issue with respect to asset managers may be more than just whether the management of other people's money makes them systemically important. Most of the companies being looked at are in a variety of businesses. And although they may be known to the average person as an asset manager, they might be involved in running hedge funds, or they might be involved in holding client cash on a balance sheet. And so there's activities beyond traditional management. And my understanding is those are the areas that have particular interest to FSOC. And at this point in time, I think the best thing to do is to let that debate play itself out rather than have a strong opinion on it from Schwab's standpoint.
Mm-hmm. Walt, just to wrap it up, we have about a half a minute. Any kind of advice or wisdom that you would impart to investors at this very confusing time?
Well, 7 out of 10 investors that we survey say that they're more comfortable investing when they have someone to talk about with respect to the markets. And that's what I'd encourage people today. There is no one with all the right answers, but getting assistance, getting a professional to guide you, I think in most cases is going to give you a better outcome than purely trying to do it on their own. There are people who can do it on their own, but they are few and far between.
All right. Well, we'll leave it there. Thank you so much, Walt. Great talking to you as always.
Thanks, Susie. Thank you, Tyler.
Walt Bettinger, CEO of Charles Schwab.
It is over, at least for now. Pfizer's bid to buy the British drug maker AstraZeneca for almost $120 billion is now off the table after a UK-regulated time limit to reach a deal expired. That sent shares of AstraZeneca down a fraction and Dow component Pfizer higher by 0.5%. So what does Pfizer do now? Meg Terrell reports.
Pfizer could come back for round 2, but not until later this year. Under UK takeover law, the company must wait 6 months before reopening discussions, or 3 months if AstraZeneca extends the invitation. Analysts say that in that time, investors will be watching AstraZeneca closely to see if it can deliver the same value on its own as the offer from Pfizer.
AstraZeneca put out some pretty lofty expectations for where they think the company can deliver over the next decade. And my sense is over the next 6 months, there could be some setbacks, and any sort of setbacks could be an opportunity for Pfizer to come back into the situation and make another bid, probably similar pricing to where its final bid was for AstraZeneca.
Others suggest it's time Pfizer look elsewhere. Analyst John Boris at SunTrust suggests New York neighbor Bristol-Myers Squibb, which he says is a leader in the hot area of immuno-oncology, drugs that harness the immune system to fight cancer. Morningstar's Conover says the company could consider Irish drug maker Shire, the maker of the ADHD drug Vyvanse. There's also been speculation Pfizer could split itself up in a few years, separating its businesses into faster-growing new drugs and older products. But there aren't any other options, analysts say, that tick all the boxes AstraZeneca did. The lower corporate tax rate in the UK, significant cost overlaps, and a pipeline of complementary drugs. So it's possible we shouldn't count out a combined Pfizer and AstraZeneca just yet. For Nightly Business Report, I'm Meg Terrell.
More now on that food deal that Tyler mentioned a little earlier in the program, and it's turning into quite a food fight. Pilgrims Pride, this is the world's second largest poultry producer, has offered to buy Hillshire brands for more than $6.5 billion. The takeover would expand Pilgrims' business beyond chicken and into hot dogs and sausages. But such a deal could derail Hillshire's own plans to buy Pinnacle Foods. It makes Bird's Eye frozen vegetables and Duncan Hines cake mix. Hillshire says it still believes in the value of the Pinnacle deal, but plans to review Pilgrim's proposal. As for the stocks today, Hillshire soared 22%. Pilgrim's Pride also rose, while shares of Pinnacle fell.
Now to China, where officials are reportedly pressing banks to replace high-end servers made by IBM with Chinese-made machines. According to a media report, the move comes as tensions rise between Beijing and Washington over allegations of cyber espionage. IBM says it's not aware of any such demands by the Chinese government.
Investors are also paying close attention to the Ukraine after a billionaire businessman won this weekend's election. The hope is Petro Poroshenko can restore order in his country and have a working relationship with Moscow. That hope pushed down gold prices to nearly a 4-month low. Steve Sedgwick has more from Kiev.
Here in Ukraine, violence continues on Tuesday in the eastern region of Donetsk, where the government now is trying to reclaim control of not only the airport, but indeed of the entire region. It was a region, of course, which was unable meaningfully to take part in the recent election, an election which gave an overwhelming mandate to President-elect Petro Poroshenko to take the country forward. There are real concerns, though, that relations with Russia are still very poor. In fact, those concerns were shared with us by Jeffrey Pyatt, who is the U.S. ambassador to Ukraine.
There are still Russian behaviors that we are deeply concerned about. This violence in Donetsk over the past 24 hours, terrible violence, seems to be fueled at least in part by people coming across the Russian border. So we believe the pressure needs to be maintained. We're trying to do that jointly with our European partners. And as far as what happens in terms of the next round of sanctions, we'll have to wait and see what Washington concludes, but also what we're able to do with Brussels.
Lots of points of tension, including over gas. The Russians say they're owed a total of $5.1 billion US. The Ukrainians, for their part, say they need to negotiate a longer-term gas price much lower than what the Russians are offering. There are real concerns, too, about whether we get another round of sanctions and that escalates the crisis. Both the US and the EU hawks are looking for a third round of sanctions. Others are saying let's wait and try and de-escalate the situation and see whether Mr. Poroshenko and Mr. Putin can come to the table diplomatically. This is Steve Sedgwick for Nightly Business Report in Kiev.
Still ahead, new rules are coming to the power industry, and they could change the way some companies do business. On Monday, the White House is expected to unveil a rule cutting emissions from coal plants. The regulation could have wide-ranging implications on companies and governments, and John Harwood joins us from Washington with more. John, what do we expect the administration to propose?
What they're going to do, Tyler, is propose regulations using the authority that the Supreme Court has recognized to regulate carbon emissions under the Clean Air Act. They're going to do it not through the sort of cap and trade system that the Congress rejected a couple of years ago, but they're going to do it by setting proportions that every state has to reduce their emissions and giving the states flexibility on how to achieve those reductions.
So, John, you just mentioned cap and trade. I mean, compare, contrast. How is this really that different?
Well, the way that it could end up being similar, Susie, is that the method a state could choose to comply with these regulations could be a cap and trade system. Remember, we already have those systems in California and in several states in the Northeast. So there is precedent for that. And one of the questions, things that we'll be watching, is whether or not the one option for states will be to join one of those existing cap and trade systems. So Western states could join with California, for example. States in the Midwest and Northeast could join the ones that are already operating one.
John, how much of a political firestorm will this create in this election year?
Very large, because you already have the trade groups representing the power industry complaining. The Obama administration hopes to split some elements of the power industry. For example, coal firms more reliant on coal will be much more deeply affected than those relying on natural gas, which is a lot cleaner burning. But you can expect battle lines to be drawn. And the core argument that Republicans and conservatives and industry are going to make is this is going to raise energy prices. And in fact, it is likely to do so. The question is, will the public accept that trade-off for the environmental benefits that will come from the system if it survives court challenge?
Thanks, John. John Harwood reporting from Washington tonight. Well, General Electric CEO tried to gain France's support today for the company's $17 billion bid to buy Alstom's power unit, and that is where we begin tonight's market focus. GE's chief Jeffrey Immelt says he's willing to partner with France's government, and he would make commitments to increase jobs in France by opening new sites.
As we build GE Alstom, we will locate the global headquarters for 4 of our businesses in France: grid, hydro, offshore wind, and steam turbines. Decision-making for these businesses will be based in France, and technology for these businesses will be made in France.
GE's proposal has been extended until the end of June. Shares of General Electric up a fraction to $26.57. Netflix is buying the rights to Sony's animated films. The pay channel Starz had the rights to those movies, but agreed to give them up to the video streaming services company. The multi-year agreement includes 1 or 2 films a year and will add to the company's already large content costs. Shares of Netflix off slightly to $398.81. Sony up more than 3% to $16.64. And AutoZone saw its third quarter earnings surge as its revenue grew and margins widened. The auto part retailer's results were helped by stronger sales in North America, Brazil, and Mexico. Despite that, shares fell almost 4% to $520.25.
Shares of WellCare and Centene rose on speculation the companies could be takeover targets. According to a report in Modern Healthcare, the CEO of Ascension Health said last week that his company was in talks to acquire an insurer that operates in 18 states. Both companies fit that criteria. That sent shares of Centene to an all-time high, up 4% to $74 and change. WellCare also rose about 3% to $76.91. BioCryst Pharma said its experimental drug, which treats a rare immune disorder, succeeded in a mid-stage trial. More testing must be done before the drug can win federal approval. But the promising results sent shares up almost 11% to $9.99. Aeropostale surged today on news that the teen retailer has secured a $150 million credit facility from private equity firm Sycamore Partners. Just last week, we told you the company posted another quarterly loss and gave a weak outlook, but today's news gave investors some hope. Shares popped 15% to $3.92. And Apple fans had another reason to buy up the stock. According to reports, the company is planning to introduce a smart home system at a conference on June 2nd. The technology will reportedly allow users to control their lights, appliances, and security systems with their iPhone. The stock rose nearly 2% to $625.63.
$10 million. That is the median pay package for chief executives of large public companies in the United States. It was the 4th straight year of hefty pay increases and the first time median compensation rose into 8 figures. Mary Thompson takes a look at what's driving the trend and who's bringing home the fattest paycheck.
As the stock market goes, so too does CEO pay. And in 2013, they both soared, the stock market by 30%, and the median pay of an S&P 500 CEO by almost 9%, to a record $10.5 million. This thanks to gains in equity-linked grants and other measures used to determine pay.
It's certainly stock price performance and total shareholder return, but it's also financial performance, revenue, profitability, various returns and margins. 2013 marked the fourth straight increase in CEO pay after a brief dip in 2009. A study by the compensation consultant Equilar and the AP showing pay gains in the C-suite behind a widening gulf in pay, as a CEO now earns 257 times more than an average worker. That's up from 180 times back in 2009. The widening gap failing to ignite investor outrage, though. Semler Brossi says only 2.5% of the firms in the Russell 3000 saw shareholders reject executive pay plans through a say on pay vote, a trend Mercer Consulting's Greg Passon credits to better communication. The companies are doing a much better job engaging with their shareholders on a very proactive basis, explaining their executive compensation program, how it aligns with the company's strategy, why it's important to be able to motivate, attract, and retain the quality of executive that they need to be successful in the organization.
The study of 337 S&P 500 firms found the CEO of Neighbors Industry took home the highest pay. Anthony Petrello's compensation rose almost 250% to over $68 million. CBS's Les Moonves' pay rose a modest 9% to a still staggering $66 million, and the mining firm Freeport-McMoRan restructured CEO Richard Atkinson's compensation as he gave up claims to severance pay. The net result? He earned almost 300% more than in 2012, taking home over $55 million. At number 4, a new addition to the highest paid list, TripAdvisor's Stephen Kaufer, as a massive option grant made up most of his $38 million in compensation. This as the pay scales continue to tip in the favor of CEOs. For Nightly Business Report, I'm Mary Thompson.
And coming up on the program, exit strategy, the 5 tools the Federal Reserve can use to get out from under its record economic stimulus program. That's next.
The investigation into General Motors' faulty ignition switch is expanding. Canada's top transportation official says her agency is now looking into 2 fatal crashes in GM cars, both of which were subject to that recall. Transport Canada has received 9 other complaints from drivers. GM Canada says it is cooperating with Canadian authorities.
Meanwhile, safety regulators have opened an investigation into about 200,000 Nissan automobiles for potential braking issues. The car models involved here, the 2013 and 2014 Sentras and Versas. Consumer complaints allege their cars continue to move even as the brake pedal is being pressed. There have been no reports of accidents or injuries.
A warning from Citigroup's chief financial officer, John Gersbach, warned that the slump in trading revenue could deepen in the second quarter by as much as 20 to 25% earlier this month. J.P. Morgan gave a similar warning as banks continue to struggle with little volatility and low volume.
And Bank of America has submitted a new capital plan to the Federal Reserve. Last month, the bank disclosed a calculation error that forced Bank of America to suspend its stock buyback and dividend. The error left the bank with $4 billion less in capital than previously thought. The revised plan is smaller than the original, and the Fed has 75 days to review it.
Federal Reserve officials broadly agree that a gradual pullback or taper of its monetary stimulus is necessary. What is less clear is exactly how the central bank will decide to control interest rates when the time is right to let them rise. Steve Leisman takes a look at the Fed's exit strategy and the tools available to policymakers.
Let's take a look inside the Federal Reserve's toolbox that it will use when it tries to normalize interest rates. A lot of background discussions going on at the Fed over this. Why? Because its main tool, The Fed funds rate's not going to work. During quantitative easing, the Federal Reserve bought all these securities and put all this cash out into the system. In order to control interest rates, the Fed has to control the amount of money in the system. So Fed funds rate goes away. What else does it have? Well, it's got this big thing. It's really an axe. It's a huge thing. Interest on excess reserves. Effectively, the Federal Reserve is going to pay the banks in order to keep that money on account at the Federal Reserve. Now, if that doesn't work, what else does it have? A thing called a reverse repo. I know it sounds complicated, but we're going to have to get used to these terms when interest rates normalize. A reverse repo, the Fed lends out a security, again, soaks up cash for some period of time. Could be overnight or could be as long as a week. And yet, folks, there is more. The term deposit facility, think of it like a certificate of deposit at the Federal Reserve. Could be something like a crowbar on interest rates if it works. You put your money in the bank, in the Federal Reserve for a period of time, the Fed pays you an interest rate. Finally, if all else fails, the Fed has a thing, the size of the balance sheet. It could actually sell assets for good. Sell the assets, soak up the cash, essentially retire the cash. So that's what we have inside the Fed's toolbox that hopefully sometime next year, if the economy is going well, the Fed will begin raising rates and use all of these tools in order to keep interest rates or normalize interest rates. For Nightly Business Report, I'm Steve Leisman.
Just when you got used to a whole vocabulary of quantitative easing and QE and taper, now a whole
Now we have term repo facilities and things like. I want to audit his expense report after that report.
That's Nightly Business Report for tonight. Thanks for watching. I'm Susie Garrow.
I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and we'll hope to see you back here tomorrow night.
I'm Susie Garrett with a Nightly Business Report news brief. Investors return from the long holiday weekend in a buying mood, pushing the S&P 500 into record territory. By the close, the Dow gained 69 points to close at 16,675. The Nasdaq added 51, and the S&P gained 11 points to close at 1911. That's a new record. On the economic front, orders for durable goods rose unexpectedly. Confidence climbed, and according to the Case-Shiller Index, home prices are still increasing, though not as much as they had been. Pilgrims Pride, the world's second largest poultry producer, has offered to buy Hillshire Brands for more than $6.5 billion. But Pfizer's bid to buy British drug maker AstraZeneca for almost $120 billion is now off the table. Be sure to tune into Nightly Business Report right here on your public television station.